different positions of the business. So, for example, we have got the value of assets, we have got the value of profit, we have got the value of liabilities. All these they are shown in separate portions of the financial statements. Now, what we want to see is that yes, one way of using the financial statements is to use these values upfront. So, for example, you look at the statement of financial position of a business, and yes, you can see total assets, and based on that you make whatever judgment you want to make. Or you look at the revenues of a business, or you look at profits of the business, the liabilities. But uh, a relatively advanced or a relatively more sophisticated way of looking at this financial information, and thus making use of this financial information, that is by comparing different figures. So, for example, we had a slight hint, a little bit of discussion on this thing, not in as much detail, where I told you that, for example, consider I've got two businesses. Okay, one of them, it has got a profit of, let's say, 100 million. The other one, it has got a profit of 150 million. And somebody asks me which of the two businesses is better. On the face value, obviously the business which earns a 150, that one looks better. But now we'll see that, is that the only piece of information that we'd be looking at, or is there more to it? So we'll be calculating ratios for the business for different activities that for by comparing the different values of different activities. So the ratios, we can divide them into two broad categories. So this is ratio analysis, where we are calculating ratios for different figures in the financial statements. And for this ratio analysis, we'll have two major types. Let me move it a bit to the side. So, it's a separate topic somewhere over here. Acha ji. Now, ratio analysis. So, we'll have two main categories of ratios that we'd be looking at. The first one would be the profitability ratios. Uh, Not exactly profit or loss, it is profitability ratio. Profitability ratios. And the other category of ratios that we'll have, those will be liquidity ratios. Okay, there is a TV show. There is a different version of it in USA and a different version in UK. It goes by the name Shark Tank, and the other one is Dragon's Den. Have you watched those shows? Asha, if you watch those shows, one thing that comes up often is that they ask for a few things when anybody they come up asking for the funding. They say, "What are your revenues?" And the person, he tell that I'm making this many millions or this many hundreds of thousands in revenues. And yes, that's one thing. The other question that they ask is, "What are your profits?" And many a times it's not enough to make a revenue. If you are, so for example, you're making a revenue of 100,000, but if all of it is drained in the form of costs, you'd be, and you'll have a lot of revenue, but your business will be loss making. Okay, to give you the example, I won't name the business, even though it's a public listed company, that's public information. One of the refineries here in Pakistan, there were a few years back just two major refineries, and one of them, it had almost the same revenue as the others, as the other one. The second one was profit making. The first one was loss making. So just having a huge revenue number, it doesn't tell much about the business. The same way, if we look at the profit, just looking at the profit, it doesn't tell much about the business. So let's consider two businesses. One of them, it has a gross profit. We'll begin with gross profit analysis. So for gross profit, the first one, uh, I'll write over here B1 and B2. So the first business, it has a gross profit of 100,000. The second business, it has a gross profit of 120,000. And we know what gross profit is, right? Gross profit is sales minus cost of goods sold. Okay. Now, one might say that the second business, it seems to be better. But if I compare it with the revenue number, for the first business, the revenue out of which they earned this gross profit of 100,000, it was 150,000. So on 150,000 revenue, they were able to earn a gross profit of 100,000. And the other business, it had a revenue of 200,000, and from that 200,000 it was able to earn a gross profit of 120,000. So the ratio that we calculate over here, this is called gross profit margin, GP margin. Okay, the way gross profit margin is calculated is gross profit over revenue into 100, gross profit over revenue into 100. So for the first business, it would come out as what is the gross profit? 100,000 over 150,000 into 100. And for the second one, it will be gross profit is 120,000 divided by revenue of 200,000 multiplied by 100. Can you give me the amount? What do you get for the first and second one, the gross profit margin? Hmm. The gross profit is 100,000. Excellent, 66.67%. And for the other one, 60%. So what we learn from here, that simply having a bigger gross profit figure, it doesn't tell, I mean, it's not the absolute answer of which business is more profitable. So what's happening over here, let's take the think of it in the example of bars. So if these two bars are the revenues for both businesses, this is revenue of business 1 and this is revenue of business 2. Out of this bar, the business 1, even though its gross profit is less, but a large chunk of this revenue is profit. Okay. As for the second business, its bar might be bigger, but a smaller chunk of this whole bar, that is their gross profit. Another way to think about it, if this example of bars is confusing, you earn a revenue. Whatever revenue that you earn, some of it will be to cover the costs that you have incurred, and the other portion would be profit. So, for example, for the first business, if they earn $100 in revenue, out of that, $67 roughly will be gross profit, and $33, this will be their cost. For the other business, it is when they make a sale of 100, out of that 60 will be gross profit and 40 will be cost. So their revenue, they are able to generate less gross profit out of it as compared to the first one, which is generating more gross profit out of the same revenue. So the first business, it will be considered more profitable. Got it? Let me know when you've noted this all down, then I'll move to the next thing. You have noted it? Acha. So the first ratio that we discussed, it was gross profit margin. Gross profit margin. The next one that we'll look at, this is called operating profit margin. Operating profit margin. Acha, for the purpose of finance and ratio analysis, remember whenever the term margin is used, it means that particular value is divided by sales or revenue. Okay. Acha. So now for the operating profit margin, the name tells me if gross profit margin was gross profit over sales into 100, the operating profit margin, it will be operating profit divided by revenue into 100, right? So operating profit over revenue into 100. Acha ji, operating profit over revenue into 100. So for same businesses, we had the figures of gross profit and revenue. Let's also introduce the figures of operating profit for these two businesses. So out of this, hmm, operating profit for the first one, let's say it was 80,000, and for the second one, it was 100,000. Okay. So now if I calculate the operating profit margin for the two businesses, for the first one, the formula would become 80,000 out of over 150,000 into 100. 80,000 over 150,000 into 100. And for the second one, it will become 100 over 200 into 100. So 100,000 divided by, that will be 50% straight away, 100. And what is it for the first one? The first one, it 53%. So for this one, it's going hmm, roughly 53%, and for this one, it is 50%. Acha ji. Now, the way we use these two ratios is we first of all compare them year to year. So we know what is the ratio for the last year and what is this ratio for this year. And obviously, the higher the number, the better. The higher number means the business is more profitable. The lower number means the business is less profitable. All right. Any confusion? Acha. And I have your full attention, right? Okay. Acha. The next thing that we have to know is there is just a third ratio since now, I mean, Uh, it could matter. I mean, it could change from industry to industry or scenario to scenario how competitive you are. Again, these numbers, there isn't a mandatory requirement of how much it should be. The benchmark that we have is, for example, last year. It Everybody would like to do better than last year, but at times it is that for certain businesses the margins, they really do not move much year to year. So for different industries, these margins, they're defined. So for example, if you are in a services business, chances are that your GP margin will be very high. Why? Because when you're offering services, the cost of services are usually not as much as when you are producing something and then selling that. Again, it could be different because at times when you're producing something and you're charging a lot of markup on top of that, you're charging a lot of profit on top of that, then again your margins, they could be higher. But usually for services industry, these margins, they are higher than the production industry. Then within the production industry, for different businesses, the margins, they would lie within a certain range, and within that range it could increase or decrease from year to year. Does this explanation help or does it confuse you more? As soon. ठीक है. So yes, you'd like to change, but if you are working very efficiently already, uh, the next, how do you improve this margin? You improve this margin either by charging the gross profit margin. You can improve your business's gross profit margin by either maintaining the sales level and increasing the selling price. So the same people, they are willing to pay you a higher price for the product you are selling, then your GP margin would improve. That is one way of improving it. The other way of improving GP margin is that you sell the product at the same price, but you control your costs. Are you taking down notes or typing something else? अच्छा, ठीक है. तो there are, again we discussed that. Again. Nice. Acha. So we were talking about gross profit margin and how a business, it can perhaps improve its gross profit margin. So one way of doing that is by increasing your selling price. But we know if I increase my selling price, the demand could go down. There would be fewer people who would be willing to buy from me now. So there is that risk. Huh. Acha, from prices perspective, whether we should increase or decrease it, and what effect would it have? Would it make more sense for a business to increase its price or decrease its price? That is something that we discuss in more detail in the marketing chapters, the marketing unit, when we study the concepts of price over there. Okay, the price elasticity of demand and all those things. So there we'll see how different businesses, they come up with pricing, and does it make sense to change price of a product or not. And what are the implications, both numerical implications and psychological implications in the market for customers when you change your price. Acha, the other way you can improve your gross profit margin is by controlling your cost. But that also comes at the risk. If you're cutting back on your costs, does it mean that your product quality also suffer? Or are you able to maintain that product quality by reducing the costs? What are the different ways and you can control your costs? Again, this is something that we'd look in more detail when we go through the operations management chapters. Any question? Acha. Acha. As for the operating profit margin, again, if you want to improve that, two ways. Either you increase your revenue and maintain. So, how you increase your revenue by increasing the quantity sold, or I mean, you have to, not exactly. I'm sorry, you don't have to increase your revenue. You have to increase your operating profits. So, down from the gross profit and into the region of operating profit, how you can increase your operating profit is by controlling your operational expenses. So if the production cost, it would first help you with the gross profit margin, and yes, then it could also improve your operating profit margin. But first, if you control the production cost, it would help you improve your gross profit margin, right? Because if I quickly redraw the format of the income statement that we had, it was revenue minus cost of goods sold, it was gross profit. So for gross profit margin, we are comparing these two values. And from gross profit, we are deducting the operating expenses and adding other income. So this gives me operating profit. And for operating profit margin, I'm comparing revenue and operating profit. So what I need in order to improve my operating profit margin, what I need to do is I need to cut back on my operating expenses. The lesser the operating expenses, the more the operating profit. So a high gross profit margin, it shows that a business, it is able to charge a lot of profit on its product. So it could be because the business is selling a very unique product, or it could be that the business, it has controlled its costs by a lot, or it could be that the brand value of the business is so strong that despite no, I mean, customers, they'd have a rough idea of what the product costs, like not the precise idea, but some idea they could have. So how much you're charging on top of that, that shows how strong your selling game is. Okay. And for the operating profit margin, I told you that the more you are able to control your operating expenses, the better your operating profit margin would become. Acha. The same way we have been comparing these profits to sales revenue. Another way of comparing these profits is not with sales but with cost. So I told you, whenever we are using the term margin, it means that particular value divided by revenue. But if I use the term markup, markup means profit. Oh, hmm. So they're all, margin is also profit, markup is also profit. Margin is profit over selling price. Markup is profit over cost. For a single item, if you are selling something for $100 and your cost, so this is your selling price. Your cost price for this particular item is, let's say, $70. So you're making a contribution margin, or you're making a gross profit per item. How much? 30. If I do 30 by 100, this will give me margin. Okay. If I do 30 by 70, this will give me markup. Acha ji. So once we know what the markup is, if I asked you to calculate gross profit markup for both businesses, can you do that? Go ahead. So for these two businesses, all the information that is required is there. You have to calculate gross profit markup, I repeat. Acha, another question. Would it make a difference? Oh, okay. Okay. Go ahead. Hmm. Hmm. Uh, Go ahead. Complete this, then I'll ask that question. Okay. The question is, would it make a difference if I'm calculating the margin for a single unit or for all the items that I've sold? For my, would it be different if I calculated it for all the items as compared to what it was for a single item? Margin margin would stay the same. I understand where in this particular case, it is just the ratio between the profit margin and revenue. If I do it for a single unit or for all the units, it wouldn't make a difference over here in this scenario. What you said is also true, but that's not what we are doing over here. We are not saying that if we are selling more units, we'll be offering discounts and the prices would change. Hmm, for this given scenario, if I do it for a single unit or for all the units, it wouldn't change. It would be the same value. Now, if you could please go ahead and give me gross profit markup for both businesses. Hmm? We have revenue, not the selling price. That is why I asked that question, that it doesn't matter if we are calculating it for a single unit or for the entire stock. So instead of selling price and cost price, we will take revenue and cost of goods sold. Revenue is 67. We are doing we are doing for these two businesses, these two, this one B1 and B2, and this is the data that is given. But markup in this case, the formula, it will become gross profit over cost of goods sold into 100. It's the same as saying selling price. Sorry, no, not selling price. It is contribution over cost into 100. For the first business, what is the gross profit? For the first business, gross profit is 100,000. The the very first value that is written, right? So for the first business, the gross profit is 100,000. So I write over here 100,000. What is the cost of goods sold for first business? That is the revenue. Cost of goods sold. Cost. It is no. See, cost of goods sold isn't given over here, so we'll have to calculate. Look at the format. That is why revision was important. Over here, we are given that revenue of the business. I'll do it on the left side so that it doesn't confuse you. The figures over here. See, revenue is given as 100,000. No, revenue is how much? 150,000. So revenue is 150,000. From this revenue, cost was deducted, and then I got how much as profit? Gross profit 100,000.